Income properties are real estate assets purchased primarily for the purpose of generating ongoing revenue. Unlike a primary residence, which produces value mainly through appreciation and tax benefits, an income property produces both annual cash flow and long-term investment gain. These properties may include office buildings, retail centers, industrial facilities, multifamily complexes, or residential rental homes. Because income properties are held for profit, they allow deductions not available to homeowners, including depreciation. Understanding how to analyze income and expenses, calculate cash flow, and determine tax implications is essential for any real estate professional working with investors. Investment analysis for income property focuses on three major areas: cash flow, tax liability, and investment performance. Cash flow reflects the amount of actual cash the property generates. Tax liability reflects how federal tax rules influence the investor's net income. Investment performance measures how efficiently the property is producing returns. Each component helps investors evaluate whether the property meets their financial goals and whether it is performing acceptably compared to competing investments. Cash flow. Cash flow is the difference between the amount of actual cash flowing into the investment as revenue and out of the investment for expenses, debt service, and all other items. Cash flow concerns cash items only, and therefore excludes depreciation, which is not a cash expense. Pre-tax cash flow, or cash flow before taxation, is calculated as follows: potential rental income, vacancy and collection loss, equals effective rental income, plus other income equals gross operating income, GOI, minus operating expenses minus reserves equals net operating income, NOI, minus debt service equals pre-tax cash flow. Pre-tax cash flow, potential rental income, $35,000, minus vacancy and collection loss, $2,100 equals effective rental income, $32,900 plus. Other income, $1,000 equals gross operating income, GOI, $33,900. Operating expenses, $17,500. Reserves, $1,750 equals net operating income, NOI, $14,650. Debt service, $10,000 equals pre-tax cash flow, $4,650 pre-tax cash flow. Cash flow measures the amount of actual cash moving in and out of the investment. Because depreciation is a non-cash expense, it does not affect cash flow. Cash flow reflects only real dollars collected and real dollars spent. Pre-tax cash flow is calculated through a series of financial steps, beginning with potential rental income and ending with the cash remaining after all expenses and debt service have been paid. Understanding each component allows an investor to evaluate how much income the property produces before taxes. Potential rental income represents the total income that would be generated if all units or space were fully occupied at the scheduled rental rate. From this amount, vacancy and collection losses are subtracted to reflect the reality of unoccupied units or tenants who fail to pay rent. This results in effective rental income. Additional property-related income, such as laundry fees, parking charges, vending income, or equipment rental, is added, and the result is gross operating income. Operating expenses include items such as repairs, maintenance, utilities, management fees, insurance, and property taxes. These expenses are deducted from gross operating income. Many investors also set aside reserves for future capital replacements, such as roofs, HVAC systems, or structural improvements. Reserves are deducted as well, resulting in the net operating income. Debt service includes both principal and interest payments on the property's financing. Subtracting debt service from net operating income produces pre-tax cash flow, which shows how much cash the investment is generating before taxes. To illustrate, consider a small office building of 3,500 square feet, renting at $10 per square foot. If fully occupied, this produces $35,000 of annual rental income. Vacancy and collection losses of $2,100 reduce this amount. Equipment rental adds $1,000. Operating expenses total $17,500 and reserves total $1,750. After accounting for $10,000 of annual debt service, the property produces a pre-tax cash flow of $4,650. Tax liability. Tax liability is not determined by cash flow. Instead, it is based on taxable income after accounting for allowable deductions such as interest and depreciation. Because depreciation and interest expenses reduce taxable income, even though they do not always represent cash outflow. An investor's taxable income may be significantly lower than their cash flow. Taxable income is calculated by taking the net operating income and adjusting it for items that were treated differently in the cash flow calculation. Because reserves were deducted earlier but are not deductible for tax purposes, they are added back. Only the interest portion of debt service is deductible, so that amount is subtracted. Cost recovery, or depreciation, is also subtracted. The result is the investor's taxable income. Multiplying this amount by the taxpayer's marginal tax bracket results in the tax liability. In the previous example, net operating income was $14,650. Adding back reserves of $1,750 and subtracting $5,000 of interest and $11,000 of depreciation results in taxable income of $400. At a 28% tax rate, the tax liability is $112. Tax liability. The owner's tax liability on taxable income from the property is based on taxable income rather than cash flow. Taxable income and tax liability are calculated as follows. Net operating income, NOI, plus reserves minus interest expense minus cost recovery expense equals taxable income times tax rate equals tax liability. Tax liability, net operating income, NOI, $14,650 plus reserves, $1,750 minus interest expense, $5,000 minus cost recovery expense, $11,000. Taxable income 400 times tax rate, 28%, equals tax liability 112 after-tax cash flow. After-tax cash flow represents the amount of income the investor actually receives after paying taxes. It is calculated by subtracting tax liability from pre-tax cash flow. Using the earlier example, pre-tax cash flow of $4,650 minus the tax liability of 112 results in after-tax cash flow of $4,538. This amount reflects the true cash benefit of the property after tax obligations have been satisfied. After-tax cash flow provides investors with a realistic measure of the property's income-producing capability. Because depreciation reduces taxable income without reducing cash flow, income properties often produce higher after-tax returns than non-income properties, making them attractive investment vehicles. Pre-tax cash flow, tax liability, equals after-tax cash flow, after-tax cash flow, pre-tax cash flow, $4,650 minus tax liability, 112 equals after-tax cash flow, $4,538 investment performance. Evaluating investment performance involves comparing the income generated by the property to the investor's cash investment and financial goals. Investors may analyze cash-on-cash return, which compares annual before-tax cash flow to the initial cash investment. They may also evaluate rate of return on equity, capitalization rate, or overall rate of return. More advanced assessments use discounted cash flow analysis, which projects future cash flows and sale proceeds and calculates the present value of the investment. Internal rate of return, one of the most commonly used advanced metrics, determines the annualized return an investor receives over the holding period. These calculations require financial expertise, and real estate professionals who lack familiarity with advanced investment analysis should refer clients to qualified financial advisors. Review summary. Investment analysis of income-producing property involves determining pre-tax cash flow, calculating tax liability, and measuring after-tax cash flow. Investors use these figures to evaluate whether the property meets their income expectations and long-term investment goals. Income properties differ from non-income properties because they allow depreciation deductions and generate annual cash income. Understanding these concepts enables real estate professionals to interpret financial projections, communicate clearly with investors, and recognize when professional financial guidance is needed. Discussion: why is depreciation included as a deduction when calculating taxable income, but not subtracted when determining cash flow? Answer: depreciation is a non-cash expense. It reduces taxable income, but does not involve an actual outflow of cash, so it does not affect cash flow. What does pre-tax cash flow measure? Answer: pre-tax cash flow measures the amount of cash the property generates before taxes by subtracting operating expenses, reserves, and debt service from gross operating income. How does debt service affect cash flow and taxable income differently? Answer: debt service affects cash flow because both principal and interest reduce available cash, but only interest is deductible for tax purposes. Principal repayment is not deductible. Why might an investor use after-tax cash flow rather than pre-tax cash flow to evaluate a property? Answer: after-tax cash flow reflects the actual amount of money the investor receives after taxes, providing a clearer picture of the investment's real financial benefit. Closing remarks: analyzing income property requires a solid understanding of cash flow, tax rules, and financial performance measures. This knowledge demonstrates professionalism and helps investors make decisions that align with their financial objectives. As you move into future sections, you will apply these concepts to broader investment strategies, portfolio planning, and market evaluation.